So if you were fortunate enough to be getting into a mortgage or refinancing during those golden COVID years, 2020 and beyond, where rates were 4%, 3%, even 2, I've seen in some cases, what if somebody came up to you now and offered you a different type of loan, but with a rate that was, let's say, 7 or 8 or maybe even 9%? What would you say? Well, I don't think you really have enough information to answer that question, do you? Wouldn't a proper follow-up question be, well, what do the two loans end up costing me in the long run over their term? And what if the loan with that higher interest rate actually would save you $100,000 or more in interest expense? Now, most people wouldn't ask that question and instead would emphatically stick with wanting to keep their existing mortgage because it had a lower number, it had the lower rate. And that's because we've been indoctrinated to think that way, that the lower number wins. But what if the lower number of actual dollars paid in interest is the winner, but that is associated with a loan that has a higher interest rate? And if this is hurting your head, I get it, because this is an entirely different way of thinking about financing real estate, but just one that's not very well known.